What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 14th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's update, we've got to spend some time to talk about what may be one of the largest moves the Fed has made in order to stimulate markets in nearly a decade, and it's coming here this month, so I think it's a very important time to talk about it, to also talk about what the Fed has done over the last 12 months to stimulate markets, and also how this could all play a role into Bitcoin's price. All right, so we've got a lot of things to discuss, but I want to let you all know real quick that this video is sponsored by eToro. Now, for those of you who may not know, eToro is a social trading platform. It allows you to interact with other traders, and they recently launched their copy trader feature for cryptocurrency trading to US traders. So you can click on the profile of any of these individuals, you can view their current stats and performance over time, you can view their current portfolio holdings, and also you can see their chart performance over time. And with a one simple click on the copy button, you can trade alongside them real time and at the exact same price. So check out the link down below in the description if you guys are interested. All right, so I want to go ahead and, as we dive into this topic, talk a little bit about where we are right now in cryptocurrency markets for a little bit of perspective here. As we can see here in the sense of global charts, back about a year ago from this date, we're here on December 14th, we were sitting at just above $100 billion in valuation. At the time, things, if you want to talk about doom and gloom, were even worse back then, I would say. I think people had completely lost faith in cryptocurrencies. But the interesting thing here is that even though we had a very exuberant rally at the first half of the year here leading up to the end of June, we have had a pretty stark correction, about $150 billion off the highs here. In fact, actually a little bit more, about $160 billion. And as much as that's about nearly getting close to about a 50% haircut in markets, at the same time, I think we need to have some perspective here. I think we need to step back and realize just how much we regain in markets during the exit out of the accumulation phase. We haven't gotten to the halving event. We haven't really gotten to the period of time where we should be experiencing another bull run. In fact, even with this rally and the correction that we had, we're about double of where we were back here around the $100 billion range. We're hovering around anywhere from around $195 billion to $205 billion, around that $200 billion mark, nearly 100% gain or double of market valuation. And that's pretty good. I would say that that's something we should definitely highlight here and keep in mind. But again, this plays a role through not only Bitcoin, but also altcoins. There was a gain pretty equally across the board in the market ever since back here throughout in December. Now, let's go ahead here and talk a little bit about what's going on in the Federal Reserve and what's going on in traditional markets. So if anyone has been watching it, you know that the S&P 500 has been continuing to rally. And this isn't just in the S&P 500, it's in the Dow Jones, it's in the NASDAQ, the Russell 2000, all the major indices are picking up steam here. And it's interesting that over the last few weeks here on the chart, you can see we've just pretty much, except for 1 week here, we basically had all green weeks. And a lot of people would be curious, what's been causing this? Has it been positive news on resolutions on a trade deal? Has it been possibly just in the last, 48, 72 hours, we now feel there may be a confident sign that Brexit may come to a resolution. There might be some understanding of what's going to go on there. Maybe it's things cooling down in Hong Kong. Maybe it's a plethora of different things. I wouldn't doubt that. But I think we understand first and foremost, that with markets, what keeps markets afloat or leads them to correct are inflows and outflows. And we've talked about this very simple principle when we talked about the halving for Bitcoin. I'll come to that in a little bit later in the video. But I want to go ahead here and talk about what's been keeping these markets afloat. And over the last decade, and not just over the last decade, but over the last 12 months, really over the last year, the Fed has been doing a lot of interesting things. Just starting back in September, they started to enact repo operations, going from no operations in repo markets to nearly around $330 billion of buy-side pressure in these markets. Now, okay, so what exactly is the Fed doing here? Well, there's three categories. You have treasury bill purchases by the Fed. So they're basically, again, purchasing up treasuries in this case, providing liquid cash to treasury holders. So this can help banks have higher reserve, raise their reserve ratios so they've got more cash on the balance sheet that they have to meet. Or it could be that they're short on cash for other reasons. So now, again, the Fed is injecting cash. Along with that as well, total term repos supplied by the Fed. So in this case, these repo operations, from my understanding, I don't want to speak from a non-experience here. I don't know exactly the total term repo. I'm assuming this is much more longer repo operations. And then you have the overnight repo operations. So these are ones that, again, are going to be done pretty much overnight, are for very short periods of time, and usually last anywhere from I would say probably it might be that the total term repo might be the 2-week repo operations, and the overnight repo are just simply for overnight operations to provide overnight liquidity, right? And again, this is for reserve ratios, it's for all kinds of different things, but mainly to make sure that there's enough cash at each of the commercial banks who are borrowing from these repo operations, right? So we've got $330 billion in stimulus that have come in that aren't attached to the balance sheet, bear in mind, of the Federal Reserve, that are supposedly all short-term operations to some degree. So $330 billion. Well, along with this as well, this isn't the only kind of stimulus the Fed has put in. They have actually added to their balance sheet. They completely reversed the autopilot that was set to go on throughout 2019 and 2020, where the Fed was going to reduce back to a normalized rate much lower than where we are. Well, this is not $4 million. This is about $4 trillion worth of stimulus that the Fed has injected onto its balance sheet over the last few years. And now, as much as we were reducing it, we have now been adding back. They've been purchasing more treasuries. They've been buying mortgage-backed securities. They are now starting to buy back the same exact assets that they had reduced from their balance sheet. And now the Fed is very much on pace here in the next couple of months going into Q1 to get back exactly where it was. So it seems like markets need this kind of stimulus. Not to mention, they're not the only ones. I mean, this is the global central bank kind of conglomerate between the Fed, the ECB, the Bank of Japan, and People's Bank of China. If you look at this, you can see a clear trend reversal that the Fed is leading here. You can see it here on the chart. And all the central banks, they have not accumulated, they have not corrected at all the levels of stimulus that they provided. They've really been holding around this range, each of them between about 5 to 5.5 trillion. So now we're getting to a point here where they're going to probably continue higher. They're going to continue to stimulate as the Fed is providing that leeway. It's coming back up. This gap has been present for a while, and they're probably going to take advantage of that, right? They're going to continue to stimulate as the Fed will. So this is not just a U.S. phenomena. This is a global phenomena. And to put it in close, right? For those of you who may doubt, you might say, Nick, this sounds like a lot of things that the Fed is doing. How do I know that this is directly correlated with the S&P 500 in equity markets? Look no further than this chart here that shows the weekly change in Fed balance sheet activity. Increases, decreases. And what happens in the S&P E-mini, which is basically a tradable form of the S&P 500. Do we need any more proof? Of course, variations, understandable. There are other things, as we talked about, the trade war, Hong Kong, Brexit, so many geopolitical factors, other policy decisions on taxes and regulation, and all kinds of things that can play a role into this. But I think we understand that the inflows and outflows of the Federal Reserve are going to provide buy-side support or sell-side support for equities, and they've been really tilting towards the buy side for a long time. Well, if this all wasn't enough, if this amount of repo operations wasn't enough, if the Fed reversing its balance sheet, if global central banks, again, turning to a net positive add on balance sheet operations, the cut in interest rates, we didn't even talk about that. I didn't pull that up on the chart here. And also the direct correlation here of Fed balance sheet activity to the S&P 500 wasn't enough. Well, the U.S. Fed has decided to continue expanding its repo operations to the tune of $425 billion, not over the course of multiple months, similar to this recent operation that started back in September and went through October and November and to here the month of December. No, this is going into the new year. This is going to be pretty much ending at the beginning of January, and it's going to be about $425 billion. Now, when I say ending, what I mean is that these $425 billion worth of repo operations, additional repo operations, are going to happen in this time window. It's not that they're going to end there. It's going to be within a matter of less than 30 days that these repo operations happen. Nearly $500 billion of new cash is going to be stimulated into the economy in the hands of commercial banks, who, bear in mind, usually have very low reserve ratios. So in this case, through tools like fractional reserve banking, all kinds of different interesting little tools that banks have, they're going to expand that $425 billion to possibly trillions of dollars, right? right? I don't want to sell it too hard in this case. It takes time for fractional reserve lending to take course, but they can expand on top of that $425 billion. And what we've seen with the previous repo operations is that these are not as short-term as the Fed is promising them to be. They are basically building a secondary balance sheet. They have continued to expand it. They have shown no sense of declining this over time. We're setting new highs every month in this case for Fed repo operations. And now they're going to expand on top of this to nearly almost about it's going to be over $750 billion in this case. And what's to stop them from going towards the big T, the $1 trillion valuation for Fed repo operations, at the same time while they're adding actual treasuries on the long-term balance sheet, while they're adding mortgage-backed securities? I mean, this is just getting absolutely insane. Now let's go ahead and understand some of the details about this. So this was released by the Federal Reserve on December 11th, just a few days ago, in a recent statement that they were going to continue to ramp up their so-called repo operations. Now let's go ahead and read the quote here. In accordance with the most recent FOMC directive, the desk will conduct repo operations to ensure that the supply of reserves remains ample and to mitigate the risk of money market pressures around year-end that could adversely affect policy implementation. Sounds like a lot of fancy mumbo jumbo. Let's break it down simply. So the FOMC, this is the Federal Open Market Committee, basically the Federal Reserve meeting together, in this case, making decisions on monetary policy and also repo operations. The desk will conduct repo operations. Basically, they're going to be exchanging new cash that they printed up overnight for treasury bills or other very high-tier secure assets, in that case, to ensure that the supply of reserves, the amount of money that a bank has in its vault comparative to how much credit it creates and how much debt that it's, or how much technical ownership, in this case, it's user's owned, but it's really in the form of credit. And to make sure that the supply remains ample and to mitigate the risk of money market pressures, basically short-term desire for cash to meet those reserve ratios. That's why we had spikes in repo markets beforehand, and the rate to borrow capital overnight around year-end that could adversely affect policy implementation. I'm assuming this is either referring to Fed monetary policy, further reduction of the interest rates, more stimulus on their balance sheet, or this could be policy implementations in relation to the trade war, all kinds of different things like that, trade policy, tax policy, whatever it may be, right? The need for that. Well, the repo offerings on December 31st and January 2nd will exceed $150 billion. And by January 14th, that's going to lead to a total that the Fed expects is sitting around $425 billion. I love this quote here. Everything's fine. I mean, again, guys, we know it's broken. Like, this is just like, it's just kind of sneaking it under the rug in this case. We've seen this for the last decade. We know the fundamentals are flawed. I'm not going to beat a dead horse. But the question here that's really important as a trader, to cut out the noise, is to think about how this can benefit you as a trader, right? I have no doubt, at least especially in the short term, if we take a look here at the S&P 500, this is obviously helping equities. No doubt about it. And I want to make it very clear that I'm not 100% confident just yet that this is going to help Bitcoin in the short term. It's certainly helping equity markets. We saw the direct correlation here with the performance on a multi-weekly time frame. The 1 week that the Fed actually declines its balance sheet, well, we see what it does to equities. So it's very clear here that this is stimulating equity markets in the short term, but it will not stimulate equity markets in the long term. The moment that these repo operations are pulled back, or if they get too exacerbated, I really think that with equity markets, it's going to serve as a hindrance in this case, because the market rally here that we're seeing, right? We've seen that over the last few years, this has been dependent on stock buybacks, a consistent inflow. The moment those inflows stop, there is no real organic buy-side pressure. Eventually, when that money dries up, or worse off, that money becomes worthless, that's going to be a huge issue for equities. The price might still continue to increase, but it's going to mean that, it's only barely keeping up with inflation in this case. We don't even know how much these operations are really inflating the base monetary supply. I can tell you it's a pretty stark amount, because the base monetary supply is only a few trillion. The overall entire currency supply is trillions of dollars because of the fact that, well, we obviously have those reserve ratios. In that case, there's only a base amount of underlying capital inside the vault at banks, and there's a much larger credit supply. It's around, I think, $100 trillion in total currency across the world. So, anyways, I digress in that case. So in the sense of the short term, yeah, this is probably going to continue to stimulate equity markets. And it's the reason why, for example, in our newsletter, I talk to my followers in this case, there are people who are subscribing to the newsletter that like, look, I'm not betting against equities in the short term. I'm not shorting it. I think it'd be silly. I mean, maybe if anything, I would buy maybe puts that mitigate my potential loss. But I'm not doing anything to bet against this. Why would I bet against free money, free cheap money being injected in equity markets? That's its first place it's going to go. Well, I'm not so much interested in that. I'm interested in what this is going to have in the sense of long-term ramifications, because I'm not a day trader and I'm not a short-term swing trader. I'm a swing trader who focuses on the macro cycles. I trade on a multi-month to a year to two-year time frame for some of the greater trends that I can find in markets. And in the sense of Bitcoin, this is going to be a net positive. Devaluation of fiat currency, over exuberance by central banks to pressure equity markets higher and extend cycles in an unnatural manner is a benefit for Bitcoin, because eventually that capital, that cheap, funny money, exits out of the market. When the buy side pressure is not enough and the sell side starts to outweigh it, when enough people realize the gig is up, that money needs to flow somewhere. It could remain as cash, and it could just sit there as cash. Someone could just literally hold a cash position. But when the dollar has been so devalued, you want to put it towards something else. You want to start to put it towards an asset class, in this case, that can help you hedge. And we might even see prematurely, right? Again, I don't want to speak too much in confidence of how this is going to react, because I might understand some of the general principles here of why Bitcoin might go up or why it might go down with monetary policy. But I can tell you in the long term, I feel a strong level of confidence that, especially when Bitcoin is sitting at about $130 billion of valuation, and we're about to inject nearly with the combined operations of what we've already done in repo markets with this new set of repo market operations, we are going to inject more than 4 times, nearing 5 times the value of Bitcoin's valuation just since September, going into the new year. This is why I always try to try to push the idea to people that, again, and it's not financial advice, but it's something to keep in mind, guys, that Bitcoin is such an early asset. Don't let short-term corrections get to you like this, guys. $130 billion is nothing. Bitcoin is just starting out as an asset. And when we hopefully continue through on this next cycle going into 2021, possibly later towards 2022, we're talking at around a price of anywhere from $80,000 to $100,000 at a little bit over $1 trillion valuation. It's not that insane. It's really not that crazy to think that we could get to a valuation range around there for Bitcoin, right? It's going to be somewhere between $1 to $2 trillion. And that's going to be at the point where people realize, oh, this is a new asset. This asset is a hedge against all of the wrongdoing of central banks. The continued stimulus and intervention that they've had in traditional markets. Now, perhaps now is not the time to be overtly bullish. Perhaps a lot of that price action happens later, and that's fine. I've been building my positions, though, because quite frankly, right now in equity markets, I don't like to buy after the longest expansion in economic history, where things are starting to move parabolic in nature. And I know that the only thing that's keeping it up is artificial buy-side demand from corporations who have high levels of cash on their balance sheet. Corporate earnings are starting to get a little bit wonky. That might not be as supportive as it has been in the past. Along with that as well, Fed operations is really much the only other thing that's keeping this up. There's not many organic buyers. JP Morgan stated in a recent article that we talked about just I think about a day or two ago that they're betting that retail investors are going to keep this market up. Really? I don't mean to be rude to you guys, because I'm a retail investor too. Does JP Morgan really think that Joe Schmo with his $500 Robinhood account is going to keep up this massively overvalued equity market? Are we kidding ourselves? They could do it down here if retail investors bought in those cheaper phases of time. But to be fair, guys, and I'm not meaning that as an insult, we don't have the liquidity to keep this up, to keep this the billions of dollars that are going to come on the sell side here as markets are really starting to enter towards more than a decade worth of upward price action. It's an insult that a bank would be so idiotic to make that kind of statement. I appreciate it, because it almost sounds like they're expecting we have more money than we do. But what we've obviously seen The middle class is dwindling. The poor are getting worse off in this case because the monetary policy that has been established by the Fed has done nothing to stimulate the underlying economy. It has gone to equity markets. I can't ramble on about it as much as I already have, guys. You get my point. But my major thesis here is, again, it depends on your time frame. If you guys want to long equities, that's fine. I will say this, a good thing to keep in mind here, we had the yield curve inversion back a few months ago, and it tends to be that we have about a 25% rally after the yield curve inversion, whereas a lot of people got bearish back then. It seems like people have forgotten about it now. Just like we had talked about on the channel, it seems like everyone has forgotten about it. There's no headlines. Retail investors aren't worried about it anymore. It was one of the many news cycle pieces. But we're getting very close to getting towards that valuation range. We're going in that parabolic nature to where we might get that historical 25% rally post when we had the yield curve inversion, which was down here in the upper $2,800, $2,900 range, or excuse me, 2,800 to 2,900 point range on the S&P 500. So it really depends on your time frame, guys. I've got some considered positions on equities, but I'm not making them very eagerly. And they're ones that are at discounts, not ones that are posting extreme rallies here. The only ones I'd ever do that for are those who have excessive stock buyback packages, like Apple. Outside of that, I don't know if I'm going to have guaranteed buyers alongside me. I don't want to be left out. That's the whole kind of idea here, right? You got to make sure that the inflows are going to outweigh the outflows. And there's a lot of different ways. It used to be that markets used to just be about buyers and sellers, but it's not like that anymore. Right? So I'm putting my bets massively on Bitcoin. I've considered gold and silver to hedge against this kind of inflation that's happening in repo markets. But quite frankly, it's mostly crypto markets, to be fair. Now, one thing, speaking in the sense of crypto markets, is I want to showcase to you guys one of the recent changes I made to my portfolio here. I definitely did not get in, to be fair with you guys, at a good time here. We're down about 20% here because I started on the eToro copy trader a little bit later than most of the other ones when the market was still moving higher. Nonetheless, though, my whole goal here is to build a portfolio here on TradingView where I make minimal trades here. I make slight allocations, maybe in the sense of my variation and bullishness between altcoins and Bitcoin. Right now, I have added to my Ethereum position. I sold my short-term Bitcoin position, and right now I'm exposed pretty evenly across the board, mostly in NEO right now because it's one of the smaller altcoins here that's still well developed. It's one of the larger ones. It's one of the large caps, but it's still small cap. And then I also have my position in Litecoin and Ethereum here. So I boosted my Ethereum position a little bit higher. So that's where I'm at right now. Those are my trades that I've posted. If you guys want to follow me in eToro, check out the link down below. But this is my current portfolio as it stands. And I think as we start to see Bitcoin reverse, you're going to see altcoins as well start to pick up. And again, we're keeping an eye on Bitcoin dominance, right? This is the major key thing to keep an eye on here. We're seeing whether or not there's going to be a trend shift here for Bitcoin dominance over the next coming weeks. And again, if you take a look here, right, go ahead and take a look at the daily time frame just to get a little bit of a closer view. We're still setting in those lower highs. And that's why I've been allocating higher and higher positions on altcoins, because I do believe crypto markets are going to start catching up, and we're going to come back down to this line of support. Sorry, I'm on the logarithmic chart. That's why it looks a little funny. There we go. So coming down here probably to around the 60-point range. 8 points for altcoins would be pretty good. So I think I'm positioned quite well. Anyways, that's it for the video, everyone. Hope you all are having a fantastic weekend wherever you are. If you like this video, drop a like and leave a comment as well if you've got something to say about the Fed repo operations, whether positive or negative, if you agree with me or disagree. I want to hear from you guys and get a discussion going. All right. Hope you all are having a fantastic day wherever you are, and I'll see you all in the next video. Stay tuned.